Hello, and apologies for there being no podcast this week, but I still think it's worth doing a little recording to essentially highlight even what's been going on this week, what's been driving markets. US markets, record highs. They're retreating slightly today on the back of inflation concerns, as well as sharply rising bond yields, and we can certainly see that borne out in this particular chart here on the S&P 500, which is retreating from the record highs that we saw put in yesterday, as well as the Nasdaq. It certainly makes a change that this week the Middle East has taken a little bit of a backseat when it comes to what's been driving markets. I think the focus, particularly here in the UK, has been the melodrama currently unfolding in Westminster, turning the UK, I think, into an international laughing stock. Yields on gilts are surging to multi-year highs. Concern over the direction of UK fiscal policy is very much front and centre. And certainly I think that is probably what I'm going to focus on for the most part in this video today. But before I go into that, let's do a little risk warning first. This content is for general information purposes only and does not take into account your personal circumstances or objectives. Nothing in this material is or should be considered to be financial, investment or other advice on which reliance should be placed. The material has not been prepared in accordance with legal requirements designed to promote the independence of investment research. European US markets have continued to diverge. More record highs for the S&P 500, the Nasdaq. Markets in Europe have been significantly more lackluster. We can certainly see that borne out in the FTSE 100, which is currently, as I speak to you now, testing the range lows of the past few weeks. I can certainly show you on this chart here when it comes up. I think the key support level on the FTSE 100 is around about 10,150, 10,160. We can see that borne out in this chart here, which I'm just about to put on the screen. As you can see there, these series of lows through here. If we break below that, we could head back towards the 200-day moving average, as well as the lows so far from earlier this year in March. So what's driving it? Well, essentially, I think there's a number of things driving the weakness that we're seeing in the back part of this week, and that is increasing inflation concerns. When we saw the US inflation numbers earlier this week, we saw a big spike in the PPI numbers. The CPI pretty much came in line with expectations, around about 3.8%, but it's the PPI numbers that I think really are starting to drive inflation concerns going forward, or what I would call persistence when it comes to inflation going forward. US markets so far have proved to be remarkably resilient. I think you can put part of that down to obviously the AI story. This week's IPO of Cerberus even, easy for me to say, surged on the open, raising $5.5 billion from its share sale. Shares surged 81% on their stock market debut, giving the company a market value of almost $72 billion. The IPO was 25 times oversubscribed. So it appears to, I think, confirm the optimism that is currently driving US markets high. Yes, we're seeing a little bit of a pullback today. I think that's quite understandable. I think we're heading into the weekend. Obviously, Trump has met President Xi in China. President Trump has also expressed impatience with how the negotiations with Iran are going. I think that's exerting further upward pressure on Brent crude prices. So obviously there is that as well, which is helping to drive yields higher across the board. We can show the chart when it comes to Brent crude right here. So I'll just do that now. Heading back towards the top end of the recent range and holding above the 50-day moving average, which currently is supporting it. Could we get a move to the upside? Certainly from what we've seen with respect to these peaks and subsequent troughs, the dips are getting higher. So that is a little bit of concern. Could we move through $120 a barrel? I certainly think that the move we're seeing in bond yields does reflect some of that concern. We're certainly seeing that borne out in what we're seeing with respect to UK bond yields. That is certainly very much a worry for investors going forward. If we look at, I'm just trying to bring up the window right now of the chart, and I'm struggling to find it. There it is. So this is the UK 10-year yield. It's broken above those previous peaks at around about 5%, 5.1%, heading to levels last seen in 2008. But I think more worryingly than that, what we're also seeing is what I would suggest is, let me just see if I can find that again. I think I've closed it now. I've got the 30-year, so I'm going to try and bring that up for you. I think more worryingly, the 30-year. So the 30-year here is broken above 5.8%, which was the previous peaks in and around here. Is it heading towards 6%? Who's to say? But again, it's a similar sort of pattern here in terms of technical analysis. We're getting higher lows. And when you get higher lows, that is a worrying sign that the trend lower in UK bond prices is starting to gather momentum, and consequently we could see a push higher when it comes to bond yields. So we're seeing that in the 30-year. We're also seeing that in the 10-year. And the reason for that is very much events currently unfolding in Westminster. We've also seen a pullback in the value of sterling. That in itself is quite stark over the course of the past couple of days. Big 2-day declines, 3-day declines even. Is that a cause for concern in the short to medium term? Yes and no. Sterling has a habit of moving sharply in one direction for a significant period of time before stabilizing. So by no stretch of the imagination is this a one-way move. If we zoom out on cable, we're not really that different to where we were 6 to 9 months ago, and certainly from where we were in November, we're still quite a bit higher. So the sell-off in sterling is not so much of an issue in the short to medium term. In the longer term, obviously, if we continue to move lower and break below those previous lows at around about 132, head towards 130, inflationary pressure could become much more of a problem. We've already heard from Hugh Pill this week, who suggested that, that's the Bank of England's chief economist, who suggested that the case is building for a rate hike. Now, that is a minority view, but given the backdrop, given the shambles that's currently unfolding in Westminster, and the unlikely event that it's going to be resolved quickly, I think uncertainty is going to be a narrative that we're going to have to become very familiar with over the course of the next few weeks and months. For me, it's becoming increasingly apparent that the current Labour government under Keir Starmer is in office but not in power. Now, the big question is, when will he resign? The even bigger question is, who will replace him? There's a load of candidates in the frame for it. Got Wes Streeting, Health Secretary, or the recently resigned Health Secretary, Wes Streeting. He appears to be mulling over a bid to replace Starmer, although he has thrown his backing behind Andy Burnham. But Andy Burnham, unfortunately, is not even an MP at this point in time. And even though Josh Simons has stepped down to facilitate Andy Burnham's return as an MP, there's by no means certain that he will actually win that seat and in turn get on the ballot paper. Then you've got people like Maura Miliband, Ed Miliband, Energy Secretary. We've got Angela Rayner also in the frame. And we've got a whole host of Labour MPs who seem to think that the bond market needs to fall into line irrespective of who becomes Labour leader. Now, with that kind of economic thinking, you have to think that things are likely to have to get an awful lot worse in order to impose some sort of market discipline on not only Labour MPs, but also the Labour government as a whole. I think the markets will need to teach them a lesson when it comes to the fact that you can't afford to ignore what the bond market is telling you, not when you're paying £110 billion in debt interest on your debt alone. And that's a figure that is likely to increase over time. There was some good news this week. We had UK GDP for the first quarter. Now, whether or not you believe those numbers are accurate, it's neither here nor there. The UK economy did appear to be in a fairly decent place in the first quarter. The problem is those numbers are dated. They're completely out of date. And next week, we will find that attention will shift to the UK inflation numbers, CPI, PPI. We've also got unemployment. We've also got wages. We've got public sector borrowing, and we've got retail sales. So there's a whole host of stuff that we need to look at over the course of the next few weeks. And with the increasingly uncertain political backdrop, I think it's going to be a very tough time for UK assets going forward. So in terms of yields, the expectation is we're probably going to see them edge higher, whether it be over concerns about inflation, persistent inflation, but also increasing fiscal risk on the part of the UK. And there is certainly a premium in that. We have seen yields rise pretty much across Europe and the US, but the rise in UK yields has been outsized in comparison to them because of the so-called moron premium that is assigned to UK gilt prices. So, or yields in general. So it's going to be a tough week for the UK next week. I was going to go over some of the numbers that came out this week, but given the fact that you probably don't want to hear the sound of my voice for an increasingly lengthy length of time, I'm going to make this as short and sweet as possible. So looking ahead to next week, we've got UK CPI for April. We've got UK unemployment and wages for March. Expecting CPI to show a further increase from the 3.3% we saw in March, perhaps as high as the peaks that we saw in the middle of last year. When we went back to around about 3.8%. Certainly maybe not in April, but I certainly think there's a case for it getting there over the summer. We've got UK unemployment for March. Obviously, that fell to 4.9% in February, but that was largely down to the fact that the inactivity rate rose from 20.7% to 21%. So that wasn't such a good news story as perhaps Labour MPs would have liked you to think. And again, the number belied a number of unpleasant cockroaches, and I'm not talking UK government ministers here. I'm certainly talking about the reduction in the labour force, lower vacancies, and obviously increased inactivity rate. Cost inflation, obviously, as well, is going to be a factor. We've seen that is accelerating, particularly in the service sector at its fastest rate since 1996 when records began. And I don't think that's a problem that's going to be going away anytime soon. Next week, we've also got Fed minutes. They're not really like to tell us anything that we don't already know. And as a consequence of that, we've already heard from the likes of Neil Kashkari of the Minneapolis Fed, who has gone on the record as saying inflation is too high, and certainly those PPI numbers that we saw earlier this week would have bared that out. So going forward, I think the earnings number to really keep an eye out for next week, there's two. There's Nvidia. Their shares are down quite sharply today, but you have to also put the fact that the share price declines, easy for me to say, the share price declines that we're seeing today have to be put in the context of what came before that, and that was a significant rally in the past few days that we've seen in the past few days, and that can be borne out by me showing you this chart here. So I've seen a very strong rise pretty much since those lows in March from $150, I believe, $160 to peaks of $241. So we're seeing a little bit of a pullback today. Obviously, we've got the first quarter numbers. I'm going to basically outline what the expectations are for the first quarter numbers. Revenue for Q1 2027 is estimated to rise to $78 billion plus or minus 2%, assuming no data center revenue from China. Now, there was some chatter out earlier this week that US officials had given the green light for Nvidia to sell H200 chips to China. Treasury Secretary Scott Bessent said that was news to him, so we'll have to wait and see how that shakes out. And also, you've got the fact that the Straits of Hormuz is still closed. So essentially, you're looking at that being a key conduit for helium and sulfur, and which is a key component in chip making, how much of that impact is going to start to feed through into the supply chains, and when will it start to be reflected in the margins of an awful lot of these chip companies? At the moment, there seems to be an overwhelming sense of unbridled optimism that this particular move higher can carry on going and going. And at the moment, the penny doesn't appear to have dropped. That I think the risks are very much headed towards the downside. Unfortunately, you never can pick the top. And certainly US markets have got scope to correct quite a bit. And European markets probably less so. But having said that, it's very difficult to time. But I'm certainly of the opinion that it's very much a buy the dip mentality, probably more so for European equities, which remains significantly lower valuations than, say, for example, those in the US. We've also got the numbers out from US retailers Walmart, Target and Home Depot. I'm going to pay particular attention to Walmart's numbers because they've been the standout US retailer for quite some time now, operating to a certain extent in the same sandbox as Amazon when it comes to the retail side of the business, and their share price has continued to go from strength to strength. We can see it with this chart here, been in a very steady uptrend pretty much over the course of the last 2 to 3 years. It's tried to retest these peaks from back in February, currently trying to push above them. I think the risk for Walmart is that we could start to see a little bit of a correction if the numbers fall short of expectations. So what are we essentially waiting for? At the end of last year, their guidance was a little bit weak. And I think the bigger question here is whether or not they're able to beat that slightly lower guidance that we saw at the end of Q4. Certainly, I think in terms of the end of last year, they had a fairly decent end to last year. The bigger question is whether or not they can sustain that. And I certainly think there is a risk here that the shares potentially could be vulnerable to a little bit of a correction. What have we also got next week? Well, you can read about it all on my Substack, but we've also got earnings numbers from BT Group, full year numbers on the 21st, and we've also got numbers from EasyJet. I think it's EasyJet. Yeah, EasyJet. First half numbers from EasyJet on the 21st, as well as full year numbers from Marks and Spencer's on the 20th. Marks and Spencer's shares actually might be worth a look because they've really struggled, despite the fact that I would argue that an awful lot of bad news is already in the price. Their shares are still languishing at the levels that we saw post the cyber attack this time last year. Now, given that, you'd have to think that perhaps an awful lot of the bad news is probably already in the price, and potentially anything that beats expectations could actually see a significant rebound to the top side. It is finding support at around about 300p. If we zoom all the way out, those are levels last seen in the summer of 2024. And as I recall, their guidance wasn't particularly great. So I think there's certainly potential there for them to beat expectations when it comes to their guidance. Anyway, that's it for this week's little video. Any questions, just stick them in the comments down below. Otherwise, hopefully, I will see you all the same time, same place next week. Thanks for watching.